Thanks so much for the introduction. So I'm going to be presenting today a poster about a broad array of statistical measures, about a very specific measure that we developed at the New York Fed with some external co-authors as well during the pandemic, which is the weekly economic index. We'll be talking about the development and the performance of this indicator during the pandemic. And the usual disclaimer that these are my views alone and not those of the Federal Reserve Bank of New York applies. We began to develop the Weekly Economic Index, or WEI, fairly early because in mid-March, as the pandemic started to hit, it already became clear that economic activity was deteriorating rapidly. But at the same time, the conventional data, either monthly or quarterly data, wouldn't be available until at least April in the case of monthly data that's available quite quickly after the end of March, or potentially even May in the case of quarterly releases like GDP. At the same time, not only would there be this delay, but we're actually interested in knowing how economic conditions were evolving from one week to the next as the pandemic worsened and potentially looking ahead as policy responses began. The Weekly Economic Index is not a nowcast of any particular measure of activity like GDP or industrial production, but rather it's a measure of real economic activity as a broad concept. It's available at a higher frequency, indeed a weekly frequency, to measure these weekly fluctuations, and is available closer to real time compared to traditional measures of activity. We first published it at the New York Fed on March 30th of 2020, and we began bi-weekly publication, which continues until today, on April 27th. So it was available quite early during the pandemic, given the needs that we foresaw. Here we just have a quick plot of the long-term trajectory of the Weekly Economic Index. It goes back to 2008. It's now available from FRED, the main data source for the Federal Reserve System, in addition to a lot of other providers such as Bloomberg. You can see the decline in recovery during the pandemic completely dwarfs any previous fluctuations in the Weekly Economic Index, in particular the recession of 2009. So what is the Weekly Economic Index? How is it constructed? It's simply the first principal component of 10 daily and weekly economic indicators. We selected these 10 indicators based on a number of criteria. First, they naturally had to be a measure of real economic activity. They needed to be available weekly or daily, so they would be available at the frequencies we're trying to measure. They had to be available in a timely manner. Well, the whole purpose of the index was that we didn't want to wait around for data that took a considerable amount of time or considerable lag to become available. These series had to have long enough samples that we could be confident of estimating the correlations of the series with each other and also with real economic activity. The series each had to have a stable definition or survey instrument in the case of the survey, and they needed to actually provide some meaningful signal value for real activity when combined with the other series. These criteria unfortunately eliminate many interesting series, including a lot of the popular types of alternative high-frequency data that became available during the pandemic, particularly some of the types of data that were mentioned in the previous presentation, because the sample and the stable definitions are just not available for some of these. The problem of the weekly adjustment for seasonal patterns is quite challenging. We sidestep this purely by using 52-week log changes of non-seasonally adjusted series for the Weekly Economic Index, which allows us to essentially have a measure that's just in terms of annual percentage changes. And we put the Weekly Economic Index in units of 4-quarter GDP growth, which is a natural pairing. To give you an idea of the series that are included in the Weekly Economic Index, we cover 3 different categories. First, on the consumer side, we have a measure of retail sales. We have a measure of consumer sentiment. On the labor market side, we have unemployment insurance initial claims, unemployment insurance continuing claims for those who are continuing to be in a status of unemployment. We have a staffing index, which measures temporary and contract employment, federal withholding tax collections. And then on the industrial production side, we have steel production, fuel sales, railroad traffic, and electric utility output. So here I'm going to plot the Weekly Economic Index with some of the constituent series. What you should take away from these plots is that for the most part, when you look at the Weekly Economic Index with its constituent series, the Weekly Economic Index is picking up the broad cyclical patterns of the constituent series, but without, in many cases, a lot of idiosyncratic fluctuations that really only show up in that one series or indeed just noise that shows up in weekly data, because this is one of the reasons why you wouldn't want to use necessarily one of these series alone to learn something about the economy. So here for the consumer series, you can see that again, the general pattern, absent some of the sorts of fluctuations that only show up, say, in consumer sentiment on the left, shows up both in the weekly economic index and in the underlying series. The same is true for the unemployment series, or sorry, for the labor market series that I report here. Finally, for the industrial production series, particularly when you look at the two bottom plots here, it's very clear that there's a lot of noise in these individual weekly series. The week taking the weekly economic index is able to purge from this underlying data. Talking a little bit more about the kind of contributions and the alternative specifications that we considered, the weekly economic index is indeed quite robust to alternative minor changes in the form of the index. But first here we display the weights that the index places on each of the underlying series. And what you should take from this is essentially that the weights are generally similar across series. No series has a very low weight, so it's deemed to be completely unimportant for determining the weekly economic index. And no series has too high a weight, so that the weekly economic index cannot be seen as essentially just the same as one of the underlying series. And over 55% of the variance of the underlying series is explained by the index. On the right, I'm plotting alternative forms of the weekly economic index compared to our baseline. So omitting outliers in the first panel has essentially no effect. Using a more sophisticated parametric model instead of non-parametric principal components has a small effect on changing the underlying index. Estimating on smaller sample sizes has virtually no effect, as you can see now. So the weekly economic index is very stable to subsamples. And using smaller numbers of series, so the 7-variable index, which actually is what we used when we first started reporting the weekly economic index, leads to a very similar index to what we have now in our baseline. And using a version based on only data that's publicly available so that someone can reconstruct on their own is again very similar to our baseline index. We provide 4 different values for each reference week of the weekly economic index, ranging from an initial estimate to the final published value. So the initial estimate is available only 3 days after the end of the reference week. So that's the Tuesday following the week ending on the Saturday. We revise it again on Thursday, provide another revision the following Tuesday, and provide the final value that Thursday, so a total of 12 days after the end of the reference week. For each of these interim updates, we're going to compute this interim value of the weekly economic index as the predicted value from a regression of the weekly economic index on lags of the weekly economic index and those data values that are currently available. So a natural question is, how soon do we actually get a good signal about what the final value of the weekly economic index will be? Do we have to really wait 12 days for the value? And the answer is we get a very good indication quite quickly, particularly from the first revision, which is 5 days after the end of the reference week. Here we're reporting the root mean squared error for subsequent releases, and also the correlation of each of these initial versions with subsequent versions. And you can see that this first revision has a very low root mean squared error for the final value that's released a full 12 days later, so a full week later, full week after the first revision, and indeed a correlation, a very high correlation as well with the final value. So we'd say about 5 days after the end of the reference week, we already have a very good measure of real economic activity. I mentioned that the weekly economic index is not a nowcast, but we can naturally compare the weekly economic index's value with those values of traditional measures of real economic activity. So here we plot the weekly economic index with 4-quarter GDP growth, and you can see that it tracks GDP growth very well historically. But because it's not a nowcast, we can also plot it against other measures of real activity. So here we're plotting against the 12-month percentage change in industrial production. And here you can see, while the tracking isn't quite as close as it is for GDP, because this is only a subset of real activity being just industrial production, we still actually track it quite well. We can also examine the contributions of all of the constituent series to the weekly economic index. So here I'm showing you the contributions to the decline and recovery during the Great Recession. And you can see that all of the different colors here for all of the different series are quite well represented. So you can see the shares coming from each of the underlying series during 2009. It was a very broad-based recession. But when we go to the pandemic-induced recession, the story is very different, and this is in keeping with the narrative that we see in the media during the pandemic. You can see the two bars in blue for initial claims for unemployment insurance, so people becoming unemployed, and people with continuing claims, those remaining unemployed, dominate the decline throughout the pandemic. You can also see some other interesting smaller stories. For example, fuel sales. As mobility ground to a halt and travel really stopped early in the pandemic, you can see those purple bars became very important during April and May of 2020. And at the same time, you can see retail went from this sort of surge in panic buying as people stocked up this light orange color, to later to actually driving the decline as well. We can also use the weekly economic index to produce nowcasts, although it's not a nowcast itself. So in these subsequent figures, we plot the weekly economic index against blue chip forecasts, so those from professional forecasters, the New York Fed's staff nowcast, and also the Atlanta Fed's GDP now, as well as the eventual values of GDP releases. So as when we started computing the weekly economic index in March of 2020, you can see that it very quickly got a much closer idea of what the eventual decline in GDP growth would be than any of these existing and well-recognized forecasts or nowcasts using a very different type of data. The story in Q2 is very much the same. The weekly economic index honed in on the eventual level of the output decline very early within the quarter in a way that these other forecasts took much longer to realize. The story for Q3 is a little bit worse for us. That's because we don't have quite as good a coverage of the service sector, which did start to recover during Q3. And we also don't think we pick up a lot of the responses to some of the policy measures that were introduced over the summer, as some of these other forecasts are able to. And in the fourth quarter, again, the performance is not as strong as it was early in 2020, but again is on par with some of these other forecasts. So while the weekly economic index is not designed to be a nowcast, it can be quite useful in nowcasting GDP growth when deployed as such. The final thing I want to show you is the weekly economic index, again, plotted against some of the sorts of high frequency novel data that was highlighted in the first presentation. So we can't include this data in the weekly economic index because its history isn't long enough for the most part. And often the sample changes quite dramatically over time. But what I want you to take away is that the turning points in activity coming from these non-traditional measures and the weekly economic index are quite similar, even though the paths may be different because the weekly economic index does take into account a broad set of data as opposed to just a single measure. But I'd argue we have a lot of the same sort of information included in the weekly economic index. So here you can see the weekly economic index with debit and credit card transactions, as well as high frequency data on hours worked. And you can see, as I said, similar turning points, but slightly different trajectories because the weekly economic index is a broader based measure. The same story applies here when we plot against restaurant reservations, hotel occupancies, and screenings at airports in the United States. You can see we're again capturing that information from the non-traditional data through the weekly economic index, although we don't include these series. Finally, we plot here against 3 different measures of mobility. And again, the information seems to be contained in the weekly economic index, although we can't include these series in it directly. So to conclude, we think that the weekly economic index, as we introduced it in March 2020, provided a very timely signal of real economic activity and a way to analyze fluctuations from week to week. Since we developed the weekly economic index very early in the pandemic, similar indices have sprung up around the world for many other countries, for individual US states, for the Eurozone, as well as actually some global economic indices on a weekly basis as well. So it's kind of given rise to a lot of similar products, particularly in other central banks. And we hope that as time goes on, these sorts of alternative high frequency data that I spoke about at the end and the previous presentation highlighted become more mature and have longer samples, we can include them in the weekly economic index as well to develop an even richer measure of real activity.